So, welcome to the December 2017 episode of Lunch with a Lawyer. I'm Steve Richardson of Richardson Law Offices. This month, we're going to deal with a very timely topic. There's been a lot in the news and in the media about the Republican Congress's tax bills. There's one in the House and there's one in the Senate. They've both passed their respective houses of Congress, and they're now in committee to sort of stitch together a combined bill to put on President Trump's desk. He's indicated he would sign it, and he promises it'll be paid, that it'll be signed. He's going to sign a bill, not pay a bill. It's going to be signed by Christmas Eve, so, to give everybody a Christmas present. Now, whether it's a nice present or a lump of coal, depending upon who you are and perhaps your political persuasion, but there's a lot of discussion going on this. But it's fairly imminent. It's very fluid right now. In fact, the notes I have and the research I've done may be out of date as of this morning. Thank you for the like, whoever's joined in. Appreciate that. Again, please let me know who you are. Jump in with a question. So it's very fluid. And if you've heard something that might be different than what I'm reading or some new development, please post a comment. Hi, Julia. Thanks for joining. Please post a comment, and I'll try and we'll get that into the discussion because this thing is constantly changing. So there are two bills, one in the Senate, one in the House. They differ in some key areas. So I'll talk about what they talk about, where they're the same, and where they're different. Now, the first topic that comes up, or at least the first topic on my list here, is the student loan interest deduction. Now, right now, and this has been around for a while, and I've written on my website, there is a deduction from your taxes for student loan interest, and it's up to $2,500. And if you qualify for it under certain requirements of your modified adjusted gross income, again, I'm not an accountant, I'm not a tax attorney, so the nitty-gritty stuff is really going to want to talk about with a tax professional. But basically, it's a deduction that reduces your taxable income. It does not reduce your taxes. So certain tax credits, which I'll talk about a little bit later, are better because they're actually a dollar-for-dollar reduction in your taxes. This just reduces your taxable income. So just to give you an idea, the maximum benefit is $2,500. Deduction is $2,500. The maximum benefit from student loan interest deduction is $625. So you deduct $2,500, depending on your tax bracket and a whole bunch of other stuff. But the maximum benefit, according to this calculation, is $625, and the average benefit in reduction in taxes paid is $202. And this is from an analysis from the American Enterprise Institute. Now, you qualify that, now this is just on interest, not principal paid. It's an above-the-line deduction, and that's an important thing. Now, what that means is, especially under these proposed tax changes, in some areas what they're looking at is to increase the standard deduction for your taxes. So in other words, you can deduct this period. You don't have to itemize deductions to get a higher deduction off your taxes. You get it right off the bat just by claiming the standard deduction, which changes the landscape to a great extent for deductions like real estate taxes, mortgage interest, things like that. But the student loan interest tax deduction is above the line. So you can get that whether you itemize your deductions or not. Okay, so you get that on top of whatever the increased standardized deduction is proposed under these tax bills. It's only available to borrowers with modified adjusted gross income of less than $80,000 or $160,000 for married couples filing jointly. And then the benefits are gradually reduced once you earn at least $65,000 or $130,000 for married couples filing jointly. So that is the qualification that you have to pass in order to take this deduction. So they're looking to get rid of that, or the House bill does. The Senate bill leaves it in place. Now, there are many states, in fact, there are 37 states, in addition to the District of Columbia, that provide their own deduction for for student loan interest. Sadly, New Jersey is not one of them. Okay, so we don't, here in New Jersey, we don't even have, we wouldn't have the state deduction, even, the federal deduction went away, and that provision of the House bill gets into the final bill. So that's student loan interest deduction. The next thing is the Public Service Loan Forgiveness Program. Now, this is a great program. It's not a repayment plan. It is a forgiveness program. So if you are in public employment, full-time, or you work for a 501c3 charity or qualifying nonprofit full-time, or if you work for several of those part-time and it adds up to full-time, and you make 120 payments on your student loan while working full-time for a qualified employer, you can then apply to have any unpaid balance forgiven tax-free. It's a great program for teachers, for attorneys and doctors who work for a governmental entity or a nonprofit hospital, something like that, where it can be a great boon to paying a lot of student loans. Face it, anybody with a graduate degree or professional degree, like a doctor or a lawyer or an MBA, this can be a great benefit. The bill's proposed to eliminate that. Now, this is part, again, it's a forgiveness program. It's part, to a great extent, part of the Department of Education. And Secretary of Education Betsy DeVos has been proposing changes. It was proposed earlier in its budget outline earlier this year, and she's looking to overseeing the elimination or rescinding of several guidance or programs within her department. So also reportedly considering ending other policies that would eliminate debt forgiveness, including an Obama administration rule that erased the debt for students defrauded by predatory for-profit programs. So if you're defrauded, they're saying, well, you still got to pay the loan. Very concerning. And it's a great program that hopefully will not be eliminated, but that is one of the things on the chopping block. Next is tuition waiver taxation of graduate students. Now, many times graduate students will work as teaching assistants for professors in undergraduate classes, or they'll do other work. And part of the compensation for that work is the school will waive their tuition, or a portion of their tuition, or all their tuition, whatever the agreement is. And traditionally, that has been non-taxable. But the problem becomes what happens if this goes away. You're basically paying taxes on money you didn't actually get. All right, they're waiving a debt. All right, and the tax code in the past has said, well, we're gonna, for societal reasons, etc., we want people to be educated on and on. We're not going to tax it, but consider the impact, though, because the defenders of this are saying, well, let's say you got $10,000 of tuition waived because you're working as a teaching assistant. Now, under the House's bill, the lowest tax bracket for people earning up to $45,000 a year, and that's $45,000 of taxable income, that's after deductions and everything else. $45,000 of taxable income, it's 12%. Okay, so instead of paying $10,000, okay, you're paying $1,200. So I guess the argument is that you're still getting a break. You're not paying $10,000 in tuition. You're paying only $1,200, so there's still a great benefit to that. And that's assuming that, grad students, do they have other jobs? Are they making enough money to file a tax return? And after deductions, how much are their actual taxes anyway? So what impact that may have, it remains to be seen, but this traditionally tax-exempt waiver of tuition is now being targeted as being taxable. This part of the bill may not make it into the final bill. There have been a lot of congressmen that have been writing in and saying, I believe that the count is up to 31, expressing concern about this cut, that it can have really significant impact on people seeking graduate degrees, which we want people to do as we become a more educated workforce, and the available higher paying jobs require more education and training. So we're not sure what's going to happen with that one. The next thing is tax credits. Now, as I said before, a tax deduction lowers your taxable income. A tax credit lowers your actual taxes. So that's even better. Now, there are 3 existing tax credits with student loans. There's the Lifetime Learning Credit, there's the Hope Scholarship Credit, and there's the American Opportunity Tax Credit. Now, the House bill looks to roll the Lifetime Learning Credit and the Hope Scholarship Credit into the American Opportunity Tax Credit and just combine it all. And the Senate bill would just leave all 3 of them in place. But what are they? The Lifetime Learning Credit, which was an improvement and expansion on the Hope Scholarship Credit, offsets 20% of the first $10,000 of qualified education expenses. That can reduce your tax bill by as much as $2,000, and obviously 20% of $10,000. And it can be used for as many years as you want, but it comes with an income cap. Your modified adjusted gross income must be $65,000 for single filers or $131,000 for married filers. And the American Opportunity Tax Credit was an expansion of the Hope Scholarship Credit and passed part of the 2009 stimulus package, the American Recovery and Reinvestment Act, and it was due to expire in 2013. It got extended through 2017. So they're looking to do what they want to do with that. The American Opportunity Tax Credit is up to, as a credit of up to $2,500, the cost of tuition, fees, and course materials. And 40% of the credit, or up to $1,000, is refundable. So in other words, if you don't pay any taxes, then obviously a credit against taxes wouldn't do any good. They actually give you the money. Okay, it's refundable to you. Hey Andy, how you doing? Thanks for joining. You can get it even if you owe no taxes. Now the bill extends credit for one extra year. So instead of 4 years, it's 5 years. So if you're taking a little bit longer to get your degree, you can have that 5th year. However, the 5th year, the tax rate is halved. It's not $2,500, it's $1,250, but it extends it on. And again, the Senate bill would leave all 3 in place. So they're sort of, again, thank you for the like. Hi, Andy. So that's that. Now, the next one is private schools and private institutions. They have these large endowments. They may have a very wealthy or grateful alumni that contribute a lot of money to the school, and they have these large endowments, and they use the interest from these investments to offset a lot of costs. It can offset the growing costs for college overall, and supply financial aid for students, pay for certain faculty positions, student research opportunities, and academic programs. A colleague of mine ended up sending his son to my alma mater, Dickinson College, which isn't cheap. But I said, oh, geez, if it costs that much to go to Dickinson, it must be outrageously expensive to go to Harvard or Yale or some of these Ivy League schools. And he said, well, actually, not so much. In a lot of ways, it can be cheaper than that, because if they want you, they have such huge endowments that they can provide you with scholarships and financial aid that's free money that ends up being cheaper. So these endowments allow you to go to these schools and pay for your education, and money you don't have to pay back. It's not a student loan. It's not something that you or your parents saved for you to go to school. So these endowments create a lot more opportunities for people to afford education and not end up graduating with a huge bill that they have to pay back. So this can have a big impact. There was a story in the Philadelphia Inquirer the other day, and it indicated that 4 colleges locally would be affected by this potentially: Swarthmore, Princeton, Bryn Mawr, and the University of Pennsylvania. Now, why I say qualifies for that is what it does is this: the Senate bill imposes a 1.4% tax on the investment earnings for endowments in a private institution, not public, with more than 500 students, and endowments of greater than $500,000 per student. The House version of the bill has a threshold of $250,000 per student. So under the House bill, you would see this tax come in even sooner and expand to even more schools. So that's the difference between the two bills, is where this tax would kick in. Princeton, for example, just to show you what the kind of impact this can have, Princeton indicated that they rely on their endowment to cover more of their operating budget and provide financial aid to more than 60% of its students. So this is a big chunk of who's going to these schools. Princeton, just as an example. That's one of the affected schools. So this is a real issue as far as whether these are, and they could be expanded further. They could change the minimum endowment thresholds and subject even more private schools to this endowment income tax. So it can have a real impact. Employer tuition reimbursements. Now, under Section 127 of the IRS Code, currently allow an employee to exclude from taxable income up to $5,250 per year in employer-provided education assistance for undergraduate or graduate studies or certificate work. Now, this money that's spent can cover tuition, fees, books, supplies, and equipment. Now, employers aren't obviously required to provide this, but it's a nice benefit that they give. And this goes back to the tuition waiver tax that I mentioned earlier. This is a tax on money that you never got. Okay, your employer is paying the tuition directly. The money never comes to you. So you would end up paying taxes on money you never got. All right, but it is a benefit, it is a value, and the IRS is looking to tax it. And this, again, can have an impact because you have employers who are saying, look, this employee is a real benefit. It would be great if we get some training for them. They can do more. They can be a greater value to our business, our company. And we want to invest in this employee and get them the training. It causes, now they're subjecting them to a tax. Now, again, the flip side is that the employee's still getting some benefit because what they're paying for the training is whatever the taxes are on the tuition. So they're still paying less. But again, it's sort of a roadblock to this sort of self-improvement in the job and the workforce. So that's something else that's being proposed. College saving plans. I talked in a previous episode of the Financial Freedom Podcast about a 529 account. That's after Section 529 in the Internal Revenue Code, and it's a type of fund like an IRA, but it's an educational IRA where you can put aside money for the expenses of a college education. But what this is saying, there is both bills would actually expand the 529 fund to include private school tuition for elementary and high school students. So right now under a 529 it's just college. All right. Now the House plan would also allow an account to be opened for a child in advance of birth. Okay, so here in the bill we're seeing an expansion, not a curtailment of a current plan. But they're also what are called these Coverdell savings accounts, named after the lawmaker that first proposed it. It's a similar plan under not Section 529 but Section 530 of the Internal Revenue Code. It's just a different type of fund, and this would bar new contributions to an account, and any monies that are in a Coverdell 530 fund would be rolled over into a 529. The reason they're doing that is part of the expansion. Since Coverdell expanded the what you could use the money for in the fund to elementary or high school or private schools, pre-college, then since we're expanding the 529s, there's really no need for the Coverdell, and they're just consolidating it. But it's for tuition, books, and uniforms for the same year as distribution. And again, it's much the same as a 529, but they're just consolidating them. And it can be, proceeds can be withdrawn tax-free for qualified education expenses at a qualified institution. So that's getting expanded. Their teachers have a current deduction for any expenses they may have for school supplies and equipment. Currently, they can deduct $250 for money spent of their own on classroom expenses. The House bill would repeal the deduction, but the Senate bill would double it to $500. So I'm going in two different directions on this one. Finally, on tax liability, they're saying that student borrowers, people who have had their loans discharged for death or disability, will no longer have to pay income taxes on the amount forgiven, on a debt forgiveness tax, and it's federal. So if you die and the debt's forgiven, then there's no tax liability to the estate. And of course, if you're disabled and it's been discharged, you're not carrying a tax bill for that. So there's some good there. So that's what we're looking at. Again, this changes daily as the committee works and new news stories are coming out. I'm sure things will change by the time you see it this afternoon if you're not watching live, or if you see it when it hits YouTube, because I'll also publish this video on YouTube. But that's it. That's where we are right now. Well, let's see where it goes. Perhaps in January's Lunch with a Lawyer, maybe we'll have more to talk about on what the bill actually is and what impact it may have on education. All we know right now is what's proposed, what the differences are, and what could end up in the final bill. But suffice to say, changes in the wind no matter what. Okay, that's it for this episode of Lunch with a Lawyer. If you like this episode, please hit like on Facebook, or even better, share this video with your friends, people that have loans or are educating a child or whatever that might be impacted by this, might be interested in hearing about it. Please feel free to share. And if you're watching this on YouTube, please hit the like button. That helps with search. And if you like the content on my YouTube channel at richardsonlawoffices.tv, please feel free to subscribe by hitting the subscribe button. But that's it for the December 2017 Lunch with a Lawyer. And got to grab lunch myself, and I'll see you next month. In the meantime, happy holidays, and may you have a good new year.